The world's leading consumer tech firms, Apple, Google, and Amazon, once the titans of sleek devices and gadgetry, are no longer just selling boxes. They are selling ecosystems. And more importantly, they are selling habits. In the last decade, the shift from one-off hardware transactions to recurring service models has fundamentally changed the economics of these firms. What began as product innovation has matured into platform monetization. For investors, this transition is more than a structural curiosity. It recalibrates how we value, compare, and underwrite these businesses. This video explores how the hardware-to-hybrid transformation affects capital intensity, margins, and valuation metrics, and why it may be one of the most important evolutions in modern business models. For most of their early history, consumer tech companies operated in a volume-based, transactional paradigm. Margins were earned in the product itself, through either cost advantage, design differentiation, or operational scale. But hardware is a tough business. Capital-intensive, inventory-sensitive, and heavily commoditized, it tends to yield diminishing returns over time. Consider the iPod or the original Kindle, both iconic but inevitably subject to saturation and margin erosion. These dynamics created a ceiling for growth and profitability. The value of a customer was largely captured at the point of sale, with limited ongoing interaction unless an upgrade cycle was initiated. This model left little room for compounding returns per user, an opportunity that services, by contrast, make central. The pivot to services wasn't just about revenue diversification. It was about reimagining the customer relationship. Services provide a way to lock in users to an ecosystem, for example, Apple ID, Amazon Prime, leverage data and personalization to deepen engagement, build pricing power through bundles and loyalty, monetize usage over time rather than at point of sale. For Apple, this meant iCloud, Apple Music, Apple Care, and now Apple One. For Amazon, it was layering Prime Video, music, and delivery benefits around a core subscription. For Google, services like YouTube Premium and Google One provide monetization pathways that extend far beyond the Android device. The model is inherently more defensible. Rather than re-winning the customer at each purchase, services anchor users into a web of utility and preference, driving switching costs higher and retention longer. At the core of the services pivot is a compelling financial transformation. Hardware gross margins, though improved via scale, rarely exceed 35% and 40%. Service businesses, by contrast, often exceed 60%, sometimes 70%, gross margin, thanks to low variable costs and strong operating leverage. This shift leads to higher blended gross margins, more stable and forecastable revenue streams, elevated enterprise value multiples as investors reward visibility and durability. The transformation also reduces capital intensity. Once the platform is built, for example, Apple Music or Amazon Prime Video, incremental users add revenue with marginal cost. The business becomes more software-like, allowing for ROIC improvements and reduced working capital requirements. Services now account for over 20% of Apple's revenue and a significantly larger share of its profits. With over 1 billion active devices, Apple monetizes its installed base through a mix of cloud storage, content subscriptions, and extended warranties. Apple One bundles these into a recurring suite, reducing churn and increasing ARPU. Analysts estimate that Apple's services segment generates operating margins north of 60%, double that of hardware. Though best known for e-commerce, Amazon's valuation is increasingly driven by recurring services, AWS, Prime, and advertising. Prime subscriptions embed customers into a loyalty loop, where additional services become more attractive and consumption increases. Echo devices further this loop, tying hardware to voice-activated services. While Android is free and open source, Google monetizes the ecosystem through search, cloud, and content. Devices like Pixel and Nest act as access points to services like Google One and YouTube Premium. Google's focus on integration, not margin on devices, illustrates how hardware can become a Trojan horse for services. The transition to a hybrid model, where sleek hardware meets sticky, recurring services, has been a triumph of strategy and margin expansion. However, this transition has not been without its challenges. As firms stretch themselves across these two economic models, tensions naturally emerge, revealing fault lines beneath the polished surface. One such tension is the risk of cannibalization. By enriching the user experience through bundled services, companies may inadvertently reduce the urgency or appeal of upgrading to the latest hardware. If your older iPhone still seamlessly runs all your paid services, the incentive to replace it every 2 years weakens. Then there's the issue of innovation inertia. The need to maintain compatibility with an expanding service layer can subtly constrain hardware innovation. A revolutionary new device feature might risk fragmenting the ecosystem or forcing a premature sunset of legacy support. An unattractive prospect when service revenue depends on continuity and seamless integration. Meanwhile, the regulatory spotlight continues to intensify. As platforms become gatekeepers, not only of content and commerce, but also of data and distribution, practices once considered savvy, like App Store fees or default bundling, now face growing antitrust scrutiny. The success of the hybrid model risks drawing the ire of lawmakers and regulators who see lock-in and opacity where firms see loyalty and integration. Strategically, the balance between openness and exclusivity becomes ever more delicate. Expanding the ecosystem through cross-platform compatibility can boost user growth, but may dilute control and compress margins. Conversely, tightening the walled garden reinforces economic defensibility, but risks alienating users and provoking political pushback. It's a high-stakes stance, one that every hybrid firm must now learn to master. For analysts and investors, this evolution compels a shift in mental models. Traditional valuation tools, like trailing PE or EV/EBITDA, often fall short in capturing the nuanced interplay between hardware and services. The two operate on fundamentally different economic rhythms, one tied to product cycles and manufacturing logistics, the other to subscription retention and daily engagement. Increasingly, analysts turn to sum of the parts (SOTP) frameworks to deconstruct these businesses, valuing the predictable, high-margin service streams separately from their more cyclical, lower-margin hardware foundations. Segment-level margin forecasting becomes crucial, as does a focus on ecosystem-specific metrics. ARPU, churn rates, customer acquisition cost, and lifetime value all come to the fore. Yes, the modeling becomes more complex, but it also becomes more meaningful. A service-rich business model implies longer cash flow tails, stickier customer relationships, and differentiated risk exposures. It's less about guessing the next blockbuster gadget and more about understanding engagement loops and monetization dynamics. And yet it would be premature, perhaps even dangerous, to write off hardware as a relic of the past. In many ways, hardware is still the on-ramp to the service superhighway. The iPhone is the portal to Apple Music and iCloud. Alexa devices drive voice engagement with Prime and Amazon's media offerings. Pixel phones enable Google's cross-channel monetization suite. The scale of hardware shipments also serves a crucial economic function. It supports ecosystem reach and helps amortize the significant R&D spend required to maintain platform leadership. Moreover, product differentiation remains a key moat, especially in a world where software can be copied more easily than industrial design. Then there's the risk of subscription fatigue. Not every consumer wants to be embedded in an endless cycle of monthly charges. Nor is the shift to services immune to disruption, especially when regulatory forces grow increasingly assertive and consumers become more aware of privacy implications. Monetizing trust-based services, especially those predicated on sensitive data, is a tricky business, and one misstep can damage the brand in ways that take years to repair. The trajectory from hardware to hybrid has momentum, but the journey is far from over. Consumer tech firms are beginning to resemble digital utilities, embedding themselves so deeply into users' daily lives that their products and services become invisible infrastructure. The next chapter may see further convergence with enterprise services, as firms leverage their consumer platforms to push into productivity tools and cross-device workflows. Content-driven vertical integration is also likely to accelerate as control over both distribution and narrative becomes more valuable. We may even see the rise of hardware as a service. Think iPhones or smart home devices sold on subscription, continuously upgraded and bundled with a suite of digital services. Pricing models could evolve too, shifting toward AI-personalized bundling, where offerings and fees adapt to each user's habits and willingness to pay. Strategically, firms may increasingly bifurcate their operations, maintaining device production for reach and identity, while scaling services for margin, predictability, and multiple expansion. The two engines will need to work in harmony, each powering a different facet of the business, but together creating a flywheel that is greater than the sum of its parts. The shift from hardware to services is not merely an accounting footnote. It's a transformation of strategy, economics, and valuation. This shift has elevated margins, muted cyclicality, and boosted investor confidence for Apple, Amazon, and Google. For analysts, it introduces new frameworks, richer metrics, and deeper complexity. And for investors, it offers a different lens, not just what these companies build, but how they monetize the behaviors they shape.